Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to cash budget, cash receipts schedule, and cash payments schedule. Get ready. It's time to take your chance with Corporate Finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that information into the blue area into our worksheet on the right-hand side, where we have the monthly cash receipts. We've got the cash schedule of cash payments or schedule of cash payments, and then we're going to take a look at the cash budget. We're focusing in on January, February, and March. So the first quarter, January, February, and March. We will be looking at some other months within the schedule because those will be necessary or useful for us to be adding to standardize the process of the worksheets that we will be then putting together. Let's take a look at the information on the left-hand side. So we're going to imagine here that the bank wants a financial plan for January through March, which is a common type of thing for trying to get a loan or something like that. We may need some kind of financial plan as part of the paperwork that would be necessary to move forward. But again, this process could be the same for just our internal purposes and our budgeting purposes as well. So we have these sales data. So the actual sales data for November and December were these two items. November and December then we're imagining have been passed, and we're now looking and projecting forward to the next quarter, that being January, February, and March. So these are actual numbers versus the forecasted numbers for January, February, March. We need to include April because April is going to be something that we're going to need for our calculation purposes. Then we have the cash sales percent. 50% are going to be cash sales. So of the sales we have then, in other words, 50% of them will be cash, 50% of them then will be credit sales, sales that then go through accounts receivable. Of the credit sales, percent paid in the month after the sale. So of the 50% of the sales that are credit sales, then we're going to say 35% of those sales are paid the month after the sale is made. So we make the sale in one month, we collect the cash in the following month, and 65% paid in the second month after the sale. So if we add then these two up, that's going to give us, of course, our 100%. We have then the material cost percent of sales. We purchases are made, so the materials cost as a percent of sales. So the materials, we're going to estimate the materials costs as a percent of sales, which is something that would often be, you would think applicable or something that we could do if we sell actual units, because then we would have a standard kind of relationship between the materials it takes per unit. So we're going to say the materials cost, we're going to estimate at 40% of the sales. And then we have the purchases are made 1 month prior to sale and are paid for 1 month after purchase. So when we think about the materials purchases, we're purchasing them 1 month in advance, meaning projecting the sales out into the future, taking 40% of the projected future sales as the purchase we are making, and then we're paying for them a month after the purchase took place, meaning they're going through accounts payable, and then we're going to pay them the following month. Then we have the labor expense as a percent of sales, 30%. So once again, we can possibly tie out our labor to the sales number because possibly we're paying, for hours worked, and therefore we can think about the amount of items that we are making and figure the labor as a rate of the materials that we are going to be making as a percent then of the sales number. Selling and admin expenses percent of sales, 15%. We're going to tie the selling and admin to the sales as well. This one's a little bit more difficult to do oftentimes because the selling and admin are more likely to be fixed in nature. So you may not always have the selling and admin tied to the sales. It might be something that you're just going to have that will be the same each month, like the rent, the utility. You might be having some selling and admin like salaries that would be the same, but it could have variable components as well, including things like sales commission that may vary and may very well tie then to the increase and decrease in the sales volume. Then we have the overhead expenses. So these are things that are typically will be fixed in nature. The rent is going to be a common example of overhead that doesn't have to be fixed, but oftentimes is going to be a fixed amount that we're going to apply, or a fixed amount that's fixed in nature of the types of costs we have. Then we have the depreciation expense per month. So that also oftentimes will be fixed or set because the depreciation is the allocation of the expense of some type of fixed asset that we are allocating the cost to future periods using some method. and therefore that method will be fixed, or it won't change, at least with relation to the sales volume. Then we have the taxes paid. We're going to say the taxes are going to be paid in January. So remember, on an accrual basis method, then we would be thinking of the taxes being applied out as they are incurred. But from a cash basis method, we are thinking of the cash when it isn't paid. Also, with regards to the depreciation, remember that depreciation expense doesn't relate to cash, and we're figuring mainly cash flows here. So this depreciation expense is something that will be on the income statement, but doesn't relate to a cash flow. And then we have the dividends paid in March. So we're going to have dividends. Those are going to be the payments to the owners of the company. They're not going to be on the income statement, but they are cash going out. They're going to be representing the revenue that has been earned, which we are now paying back out to the owners. Then we have the cash beginning balance. I'm just gonna beginning balance. Cash beginning balance for January is $130,000. The minimum cash balance we want is $125,000. That means that we want to have that minimum balance in the bank account. Even if we dip under it, we'll take out a line of credit in order to pull us back up to that minimum amount. Let's go back up. Let's take a look first at our monthly cash receipts. We'll go through this a little bit faster since this is more of our comprehensive problem and we've seen these in the past. We're going to pick up these sales. The November and December are red because those are times that have already passed. But we need them in our worksheet to calculate for January, February, and March. So November is going to be equal to, I'm going to scroll over to that 445 and then select tab on the keyboard. December will be equal to that 722, selecting tab on the keyboard. January is going to be equal to that 783, tab on the keyboard. Then we have February, that 827, tab, and then March, scrolling over to the 604 and tab, and then April, outside the period we are looking at, but possibly necessary to calculate some other component. Therefore, it's easier to have them in the schedule up here so that we can use the same uniform kind of formulas and be able to autofill those formulas and have the same structure to copy and paste formulas. Then let's pick up the credit sales. Let's think about the number of sales that are going to be credit sales here. So we got the total sales number. Cash sales are 50%. Therefore, credit sales is going to be the other 50%. Now, notice it's 50-50, so you could pick up the same 50. But I would say I would pick up 1 minus that 50% in this format. So I'm going to say this is going to be equal to the 455 times brackets. And then, so that's not times brackets 1 minus that 50%. And then close the brackets. You might say, why would I do that? Because it's still just 50%. And the reason is because if I was to change my estimate over here and say, make this 60%, then this would be changed appropriately. Instead of taking 60%, it would be taking 40. You want to set up your worksheet so that you can change these numbers on the left and then easily change your projection without having to do anything fundamental or having to do as little things over here in the actual worksheet as possible. So your data is over here, your worksheet's over here, and that you want to keep those two, to a minimum to kind of make any adjustments. You can imagine going to like the bank and the bank telling you, well, we want this, that, and the other thing to change this, that, and the other thing. Well, you want to make all those changes as easy as possible over here and not in your actual calculations if you can. So now what we're going to do is I'm going to copy this over all the way over. And to do that, I need to make this an absolute reference. I don't want that 50% to be moving over, although I do want the A2, which is the sales number, to move over as I copy this to December, January, February, and March, and April. So I'm going to put my cursor in B14, select F4 on the keyboard, making that an absolute reference, putting a $ before the B and the 14. Putting my cursor back on this, we're going to autofill, putting our cursor on the autofill handle, dragging it all the way across, and then double clicking on the end number just to see if it does what we want. It is picking up that 51 minus the 50% times the sales. Looks good. Notice you don't need an absolute reference. You could use a mixed reference. I get comments on that sometimes, but an absolute reference works. So that is what I would use there. We're then going to say that we want the cash sales. So the cash sales now, you could calculate. We're looking at the actual flows now, the inflows, which we're going to break into the cash sales and then the amount that we're going to receive on the payables. So the cash sales could then be equal to the sales number times the 50%, which is one way you can calculate it. And then, or you can calculate it as we have the sales number minus the credit sales. That's another way that that you can calculate it, because we already have the other side. Now, you don't need to do these two. I'm actually going to delete them for these two because November and December is not what we're focusing on. We need this data up top in order to calculate the period we are focusing on, January, February, March. So once again, you could say in January, the sales number, top line, 783 times, and then pick up the 50%. Or you can say, well, I have the sales number minus the credit sales, and that would give you the correct number as well. Let's do it the other way again. The 604 times the 50%. So there we have that. Then let's go to the credit sales that we're going to be collecting 1 month after the sale took place. So now we're looking at the credit sales. I'm looking at the December sales that were made on credit that are going to go through accounts receivable that are going to be collected then in January. We're going to collect 35% the month after. So I'm going to be picking up then the 361,000 times that 35%. I want to be able to copy and paste this over. I don't want the 35% to move. Therefore, I'm going to select F4 on the keyboard, putting a $sign before the B and 16, enter. Then I can copy this across, putting our cursor back on it, autofill handle, and dragging that on over to March. Double clicking on the March number to see if it does what we want. It's picking up the prior month times the 35%, looks correct. Then we're going to say what we're going to collect 2 months after. So we're looking at the credit sales that we're going to collect 2 months after, which is why we need the November number here. So we're going to be picking up the November number times the 65% when considering the amount that will be collected in January. So we're going to be picking up then the 227.5 times the 65% down below. I want to make this an absolute reference so that I can copy this across, making this number change as we go over to February, but not the 65%. Therefore, we're going to put our cursor in B18, select F4 on the keyboard, making it an absolute reference, $sign before the B and 18, enter. Put our cursor back on it, autofill handle, dragging all the way on over to March. I'm going to put an underline under these now, since I'm already have them selected, Home tab, Font Group Underline. We're then going to go to the total cash receipts, is going to be our bottom line number for the inflow of the cash. In January, we're going to sum these up using the trusty sum formula. The trusty sum function equals the SUM, Control 9, up arrow one time, Shift, holding down Shift, and up, up, up. So there is our sum function, enter. I'm going to copy and paste using the keyboard this time, Control C, left or right arrow, holding down Shift, right arrow, and Control V to paste that out, double checking by double clicking. And it looks like it is summing the proper place there. Let's go to the cash payments now. On the cash payment side, the most confusing component is typically the material purchases, because those often go through accounts payable, where we're going to be paying at a time different than when we actually purchase the materials. So let's think about when the purchase happened first, and then we're going to go into when the payment happens. So we have the material costs percent of sales. So 40% of the sales is what is the materials that are cost. The purchases are made 1 month prior to sale and are paid for 1 month after purchase. So notice we're going to say now that the purchases are made a month prior to the sale. So if we're talking about then the December number, and we're going to need December because we're going to need it in some other calculation, even though we're focusing in on January, February, and March, then we're going to say, well, I got to look at January sales. So January sales is this 783 up top. So I'm going to be picking up then the 783, multiplying it times the 40%. So 40% of the following sales number. And notice it's a little staggered here because obviously I don't have a November down here. If I hit enter, we're starting at December. I don't have a November column because it's not necessary for this worksheet. So it's a little bit staggered then when you try to compare the months up top, you may, get a little bit off because you're expecting them to line up to the months here, and they don't because we don't have November. Okay, double clicking on this, we want this one then, we want to copy that across now. So we're going to copy that across, double clicking on this. We need that to be an absolute reference, so I'm going to put my cursor in the B20 and say F4, put in a $sign before the B and the 20, then enter. Put our cursor back on it, autofill, put our cursor on the fill handle and dragging it on over to March. Now that we have our materials, we can look at the actual payments that are going to be taking place. The payments that are going to be taking place for the materials are now going to be paid out of accounts payable. So we purchased them in this format in these months, and then we're paying for them in the following month. So we purchased the 313,200 and we calculated that based on the following month, and now it's in accounts payable, but we're going to pay it in January. So I'm going to say this equals the prior month, the 313,200. Now note, you could have just said, let me just have the materials payment schedule and be picking up then, January times the 40% and kind of skip this step up here. But this step is often useful to see in our mind what is actually happening. What is actually happening? It's going through accounts payable. It's going through accounts payable based on the fact that you purchased this for the following month, based on the number for the following month, and then it's in accounts payable and you didn't pay for it until the month after. So I think it's useful to have that two-step process normally. So once again, we got the materials here, you're imagining, didn't pay for them yet, and then we paid for them here for the month here. As we purchased these on account, didn't pay for them yet, and then we're going to pay for them. Okay, so then if I copy this across, autofill this across, no absolute reference type of thing needed. We'll just simply copy across, double click on the last month, check if it's doing what we think it should. It is, it's picking up the prior month. So there we have that. Now we're going to go to the labor. The rest of these are a little bit more straightforward because we don't have that kind of staggering process between the month. And we're going to be then picking up the labor, which it says, what does it say for labor? Is 30% of sales. So it's just simply 30% of sales. So we're just going to say, all right, that's our estimate. This is going to be equal to, and make sure once again you pick up the January number, which is going to be over 1, January to January, times, and then we're going to be picking up the 30%. I want to make this an absolute reference because I want to be able to copy this over and not move the 30%. Therefore, I'm going to put an absolute reference, selecting B4, $sign before the B and 25, enter. Then put our cursor back on it, drag it using the autofill all the way over. Double click on the final cell. That 30% looks good. Picking up March, that looks good. Then we're going to go to the selling and admin. The selling and admin expenses. And those were 15% of sales. So we're just going to simply do a similar process here. This will be equal to, make sure you're picking up the January sales up top and then multiplying that then times, scrolling on down, that 15%. We want to copy this across. Therefore, I'm going to make that 15%, which is represented by B29, an absolute reference by selecting F4, $sign before the B and 29, enter. Then put our cursor back on it, autofill handle, dragging that across. Double clicking the final cell, checking the 15 looks good and the March looks good. Next, we have the overhead. The overhead is going to be the next item. The overhead is going to be equal to, this is usually a fixed amount that's going to be applied. That's going to be equal to the 40,500. So the 40,500 and enter. And I want to make that an absolute reference so I can copy that same amount across. Therefore, F4, $sign before the B and 33 and enter, putting our cursor back on it, auto-filling that across as well. Then notice what we're going to do is we're going to skip the depreciation. So this one's kind of like a factor that's going to be put in there because it's an expense, but there's no cash related to it. We're focusing in on cash flows, therefore no depreciation expense. We have the taxes paid in January. Remember that taxes are generally something that if we were to look at the income statement month by month, we would apply out to when we incurred them. But on a cash flow statement, we're going to put in when we pay the tax. So we're going to have to put the taxes that we're going to pay up top. So with taxes, we expect to pay them in January. So I'm going to say this will be equal to, and just pick up that 10,500 and just that is it. Again, on the income statement, it would be applied over to the period in which it was incurred as an expense. And then we have the dividends. Remember that the dividends represent cash going out. They're not on the income statement because they're representing the money that has been incurred or earned that has now been given back out to the owners, and that's going to happen in March. We're going to say that the dividends are going to go out in March of the 14,500, and that should be it. So I'm going to underline, even though there's no numbers in this cell, I'm going to format them all the same way. Home tab, font group, underline. Then I'm going to get the total cash payments. Bottom line, total cash payments, summing up January through March by saying equals SUM, shift 9, up arrow once, holding down shift, up, and enter. I'm going to copy that across, control C, right arrow, shift, and over, right arrow, and control V, and then double check this last one to see that it is indeed what we want. Looks good. Now we have what we need to do the cash budget. Remember the format of the cash budget. We're not going to start at the beginning balance, then show the inflows and outflows, and then the ending balance, but rather start with the inflows and outflows, then add the beginning balance to get us to what would be our ending balance before considering any loan amount, and then consider whether or not we need a loan in order to reach our minimum balance that we want to have on hand, using a line of credit if necessary at the $125,000. So let's start that out. We're going to say the cash receipts then are going to be the first item. We're simply going to pull this from the table that we made on the cash receipts. So cash receipts for January 65725. Enter. I'm going to copy that across, Control C, and then Control V. Pasting that across, double checking by double clicking on this item. It's pulling up the proper amount for March. That looks good. Then we've got the cash payments. So, and I can do this way. I can just say equals the total cash payments. In January, that'll be equal to the bottom line of our schedule. And then I'm just going to say Control C, right arrow, holding down Shift, right arrow, Control V, pasting those, double checking this one to see that it is pulling from March, which is what we would expect. That's going to give us our net cash flows, which is going to be the inflow minus the outflow. Inflow minus the outflow equals the inflow minus the outflow. The E22 minus E23. I can copy that. Control C, right arrow once, holding down Shift, right arrow again, Control V, and there we have it. Now this is the flow. We had a negative flow and then a positive flow. Let's put an underline, selecting these three cells, Home tab, font group, put an underline there. And then we're going to be adding to this our beginning balance. Now the beginning balance for any month is going to be the ending balance for the prior month, but we're going to need some place to start. They gave us the starting point, which was the beginning balance for January, which would be the ending balance for the prior year of prior December. This is going to then be equal to the 130,000. So then we're going to go to our cash before we consider any loan balance, and I'm going to sum these two up and see if we're above what we want to be, the minimum cash, which is the 125, which we will not be. So I'm going to equals the sum of these two items. This is a subtraction problem, even though we're using the sum, which is an addition formula. Let's put an underline here, Home tab, font group, underline. That's because there's a negative number and a positive number, by the way. That's why it's a subtraction problem, even though we used the sum function, which is an addition formula. So now we want to get to the minimum loan balance here of the 125 because we're below it. So what I'm going to do is I'm going to take this 125 that we want to get to minus where we are at, meaning we need another 45,825 to get to, if we sum those two up, the minimum balance we want of 125,000. Therefore, we're going to take out the line of credit for that amount. So I'm going to go Home tab, font group, underline there, and that's going to give us our ending cash balance. The ending cash balance then being equal to the sum of these two items, that being the 125,000. So now we have the ending balance here for January, which will be the beginning balance for February. Before we start that, however, let's just track the loan balance. So this is going to be just a track of the loan balance outstanding. If this is the first time we took out the loan, we're now at the 45,825 balance outstanding for the line of credit that we're going to need to pay off in the future. So now we have the beginning balance for February is going to be equal to the ending balance for January. So now we can add these up, equals the sum of the activity and the beginning balance. Let's put an underline here, home tab, font group, underline. Now we are over the 125,000 balance that we want as our minimum balance. Therefore, we can pay off the line of credit, or at least part of it. So we're going to pay off the line. We're going to pay off as much as we can to either get to the loan balance down to 0 or down to our minimum balance of 125,000. Now we're not going to be able to get down to 0 because you can see we were at 41,725 and then we added the 125. So we don't have enough to pay off the 45,825 and still be at our minimum balance of the 125. So what we're going to do is we're going to say that I'm going to say I need this to be equal to this number minus the minimum balance, the 125,000, and that's going to be the loan. Let's do it the other way, actually. To make it a negative number, I'm going to make it the 125,000 minus the balance that we have. And that means we're going to decrease it by 41,725, meaning we're going to pay off this balance, but we're only going to be paying off the 41,725 because if we net those two out, it'll bring us back to our minimum balance that we wanted at the 125,000. We don't want to dip below that amount, but we want to pay off the line of credit whenever we can, if we can do so without dipping below the 125,000. Let's sum these up, which will subtract them. Summing these up now. And there we have that. So now we're at the 125,000 again. Let's put the underline, home tab, font group, underline. Loan balance now equals the prior loan balance plus what we paid off, which is a negative number now at the 41,725. That means we still have a loan balance outstanding of the 4,100, which is the loan that we originally took out in January, paid some of it off in March. And obviously we're not considering the interest involved here. So we're looking at the loan balance, just the principal balance that we have. All right, so then we're going to say that the beginning balance for March is the ending balance for February. We can then sum these up, equals the sum of the activity and the beginning balance. Let's put an underline here, home tab, font group, underline. So this is our new balance here. So we're way over the 125 now, and we only have 4,100 loan outstanding. We can go ahead and pay that off and still be well above the minimum balance of the 125. Therefore, we're going to pay off that 4,100. Let's sum these up, equals the sum of where we are at before we pay the loan and the payment for the loan, taking that down. And then we're going to then put an underline here, home tab, font group, underline. And then we could say the loan balance equals the prior loan balance plus the activity of paying it down, the 4,100, bringing the loan balance down to 0. End of the day then, at March, our balance is at 253.7, and that loan balance is back down to 0. This is a good trend.